What's up, everybody? As promised, this is my weekly video of my past trades for the past week. I did a total of 3 trades this week. There'll be weeks where there'll be many trades. There'll be weeks there may be no trades. But this week I had 3 trades. So let's get into it. But before I do, let me give a disclaimer. This is for informational purposes only. I am in no way recommending buying or selling a stock, security, option contract, or anything of that nature. This is strictly info. I'm sharing with you guys what it is that I do in my trading account. So let's get started. The first trade that I did was on the 13th, and it was Google. It was a Google trade. I received a signal that Google was likely to go down, and this is the daily price chart of Google, and this is the daily price chart of the stock option, basically the contract. Remember, like I said in the previous video, you can speculate whether a stock is going to go up or down, and if you think Google is going to go down, there are contracts. These are the contracts that you can buy at what they call different strikes, which are different prices that you bet Google is going to go down or up. In this case, on the 13th, Google closed at 1440. When I put my cursor on this bar, look at this box up here. You can see the date, you see Google symbol, and you see the closing price, which is 1440.03, and it gives you the open, high, low price of Google that day. What we're paying attention to is the closing price. So it closed at 1440. So I purchased the 1410 put contract. When you think it's going to go up, you can buy a call contract. And when you think it's going to go down, you buy what is called a put contract. In this case, I was betting that it would go down by expiration Friday. Any contract that I purchase, it expires that Friday. So I bought the 1410 put contract. You can see it here. And on Monday, the 13th, again, look at the box. That contract closed at 170. I got in the contract at 150. Let's take a look. This is the week's trades. So Google on the 13th, I bought one contract at $150. My total cost basis was $153.60. That's including the commission cost of this trade. Now this trade was a break-even trade, meaning I got out of it because the next day Google did trade down, but it didn't trade below what my strike price was, which was 1410. In fact, it only hit a low of 1427, and it closed that day at 1430. And as you can see, days after, the next 3 days, Google just went up, because right now the market is in an uptrend mode. It's trending upward. So had I stayed in this position, I would have lost my total amount. But by me getting out at break even, I just got out of it and on to the next trade. But let's go to the next one. Uber. Again, a sell signal on Uber. This was on the 14th. You see Uber closed at 34.84. I bought the 34.50. So I was speculating that Uber's price would go down below 34.50 by Friday. That contract closed at $40 that day. I got in the position at $41, so my total cost basis was $127.90. Let's see what it did. Remember, the red bars mean there were more sellers than buyers, which drove the price down, and the green means that there was more buyers than sellers, which drives the price up. I got in here the next day. Uber trades up against the position. My contract goes down to $22. Thursday closes at $21. It only hit a high of $50. Remember, I got in at $41. And as you can see here, Friday, it went down to zero. It expired worthless. So this trade was a total loss. I lost $127.90. You can only lose what you risk. So I lost $127.90. Let's go to the next trade, Lyft. Lyft also, I received a sell signal on the 14th. It closed at $47.68. The contract was $47, and it's the 47, meaning I was betting that Lyft would be below $47 by Friday. All right, let's see what it did. The next day it traded all the way down to $22, then closed at $55. And here it hit a high on Thursday of $100. I got out at $100 for 100% return. I only had to risk $98.25, but I sold out of the position, so I doubled my money on that position. So 1 in 3 for the week. Now let's get into the important statistics, the numbers. All right. For the year, I've made a total of 6 trades. 6 trades I've made this year, and my net profit and loss, my net P&L is negative 484 at a 33% win percentage. So out of those 6 trades, 33% were winners, the rest were losers. And this is my payoff ratio as of now, and this is what is called expectancy. This is the most important number out of anything up here, because what this is, it shows you the amount of money that you could potentially make, that you could make in a series of trades. An individual trade is insignificant, especially if you're managing your bankroll properly. You know what I mean? So even the win percentage, most people would think, oh, well, I need a high win percentage in order to be profitable. That's not true. And what you will see as we continue to make these trades and make these videos, you're going to see how insignificant this number is and how important this number is. And you're going to watch this net P&L change. The gross P&L is not including the commission cost. This is including the commission cost, because there are fees anytime that you make a trade. Although most brokerage firms don't charge fees anymore, but we'll get into that at a later date. But 6 trades, these are the trades that I made. My gross P&L per trade, you see it on that Google trade that I made. I lost $225. that was the second trade that I made. So basically 2 winners out of 6. So that's a 33% win rate. But this number here is what you want to pay attention to. Let's look at it in a chart form. This is my account. As you can see here, this is the equity curve. I'm on a downswing, and this is where I'm at now. So I'm down $450 something. So let's look at a deeper analysis of what it's all about. Winning trades were 2. My losing trades were 4, and this is what they equaled up to. So right now, I averaged $67 per win, and $147 per loss. What you're going to see is you're going to see why this number is the most important as we continue to make trades. These are the stocks that I track. You see, I got all the big boys there: Amazon, Boeing, Baidu, Beyond Meat, Facebook. I got all the heavy hitters. These stocks I choose because they're the most widely traded. They have the volume that I'm looking for, and it's easy to get in and out. When I simply look at what I do, I'm a quarterback, and these stocks are my receivers, my running backs, and all I'm doing is I'm distributing capital, distributing risk to each of these stocks. Some of these stocks I consider to be my star receivers. Amazon, Google. You're going to see trades in which I may risk $100, $150 or $200, and you may see this stock go up over $1,000 or better. They're going to be trades like this. So these stocks are my go-tos. And like I said, I'm quarterbacking by just distributing risk, distributing capital, with the goal of profiting in the long run. An individual trade means nothing to me. Losses mean nothing to me. Losses I consider to be tuition costs. It's the fee that you pay to be in those winning trades. So you cut your losses, when you have them, you accept them, and you let your profits take care of themselves. I'll probably be doing another video to explain more in depth the charting. All right, thanks guys.